You know, every so often, you see something in an earnings report that really makes you sit up straight. This past quarter, we saw it twice. Hidden in the results from Alphabet and Amazon was the start of something massive, an AI-driven capital spending cycle on a scale that is, frankly, unprecedented. Today, we're going to dig into this new arms race. We'll look at the numbers, the strategies, and what this all really means.
So here's how we'll break it down. We'll start with Alphabet and see how they're pouring fuel on their cloud ambitions. Then we'll switch over to Amazon and the story of AWS getting its momentum back. After that, we'll compare their strategies head-to-head, because they are different, and we'll wrap it all up with the one big question this whole spending spree forces us to ask.
All right, before we get into the thick of it, just the necessary disclaimer. This analysis is for educational purposes only. It is absolutely not investment advice. Any of the numbers or expectations we discussed are just for illustration, and they are certainly not a guarantee of future results. Okay, let's kick things off with Alphabet. Now, on the surface, they posted a very strong fourth quarter. But the real story, the one that tells us where the future is headed, well, that's buried in the details of their cloud business and their absolutely staggering spending plans.
So here are the headline numbers. And look, they're impressive pretty much across the board. Consolidated revenue up a very healthy 18%. But I want you to draw your eyes to one number in particular. See it down there? Google Cloud revenue, up 48%. That's not just growth, that's an explosion. And it's really the engine for this entire conversation.
And beyond that incredible 48% growth, the real story here is about profitability. The cloud's operating margin nearly doubled, jumping to over 30%. Now that proves they're not just buying growth at any price. They're building a genuinely profitable, scalable machine, all on top of that incredibly steady foundation of Google Search. And this chart, this just visualizes that story perfectly. On the left, you've got that strong revenue jump for Google Cloud. But look to the right. The operating income bar has more than doubled. This is what high-quality, profitable growth looks like. This is the moment Google Cloud officially graduates from being a promising but costly venture into a mature, powerful profit center for the whole company.
Of course, no report is perfect. The Google Network business, that's the ad revenue from other people's websites, not Google's own, was actually down a couple of percent. But more importantly, this is where we see the real theme of this story emerge. Capital expenditures, or CapEx, are beginning to accelerate at a truly astonishing rate.
So what keeps this from being a 10 out of 10 report? Well, for me, it's about seeing a clear roadmap for how they plan to monetize AI across the entire business. We see how it's turbocharging Google Cloud, sure. But how exactly will it supercharge search and YouTube to justify the incredible costs we're about to see? That part of the story is still being written.
And this brings us to the single most important line from their entire earnings release. Management guided that their capital spending for 2026 would be somewhere between $175 and $185 billion. I'm just going to pause there for a second. Let that number really sink in.
$185 billion in a single year. This is a level of investment we've almost never seen before. And it's all being plowed into building out the infrastructure, the data centers, the servers, the custom chips that they believe they need to win the next era of artificial intelligence.
This chart shows you their strategy in one simple picture. The blue line is their capital spending. The green line is their expected cloud revenue. You see that gap? They are pouring billions into the ground today because they are absolutely certain that massive AI-driven demand is coming tomorrow. It's a deliberate, aggressive strategy to invest far ahead of the curve.
All right, now let's pivot to their biggest competitor in the cloud wars, Amazon. They also turned in a very strong quarter, and the story here mirrors the same scale of investment, but with a slightly different strategic focus.
So looking at Amazon's Q4 scorecard, your eyes immediately go to two places. First, their advertising business, up a stellar 23%. And then, the big one, Amazon Web Services, AWS, up nearly 24%. And that AWS number, that's the key. It signals a really crucial turning point for the business and for the whole industry.
You see, that AWS reacceleration is a massive signal. For the past year, the story was that companies were tightening their belts, trying to optimize their cloud costs. There was a real concern that growth was slowing down for good. Well, this 24% figure tells us a new wave of demand is here, and it's almost certainly being driven by AI. That slowdown concern is now officially off the table.
This chart tells that comeback story visually. You can see the orange line there, which is the year-over-year growth. It had been trending down, but this quarter it clearly hooks back up. That's a textbook inflection point. It's powerful proof that businesses are opening their wallets again for the cloud, and a big reason for that is new AI projects.
Now, on the other side of the coin, the most noticeable lowlight was the 16% drop in free cash flow. This isn't necessarily a sign of trouble. It's a direct result of the huge investment cycle they're in. Still, it's a number that makes you take notice. And meanwhile, their physical stores just continue to lag behind.
So what prevents this from being a perfect report card? Well, while AWS is firing on all cylinders, there's still a lot less clarity on the long-term returns for their massive spending in other parts of the business, like logistics and retail. The path to profitability outside of the cloud just isn't as clear.
And here we go again. Just like Alphabet, Amazon signaled its own massive spending plans. They expect to invest around $200 billion. But listen very carefully to the reason they gave. Because we have very high demand. That's a critical difference. This isn't just building for a future they hope will come, they're building to fulfill orders they practically already have.
$200 billion. An even bigger number than what we saw from Alphabet. What this tells us is that Amazon is pressing its advantage in the enterprise cloud market hard. They are making sure they have the capacity to handle the absolute tidal wave of AI work they see coming from their corporate clients.
So let's step back and put these two giants side by side. What you have here are two corporate fortresses, and each one is using hundreds of billions of dollars to build their moats even wider and deeper. They are both fighting for the exact same prize, dominance in AI, but their battle plans are importantly different.
Here's the difference in a nutshell. Think of Alphabet's $185 billion investment as a broad ecosystem play. It's meant to power their own huge services like Search and YouTube, while also serving the general public cloud market. Amazon's $200 billion, on the other hand, is like a surgical strike. It's laser-focused on expanding AWS to capture that massive wave of enterprise AI demand.
When you add this all up, we're talking about nearly $400 billion in capital spending from just these two companies. The big picture becomes undeniable. The investment cycles that built out the internet or the mobile phone revolution, they are going to look small by comparison. We are in the very first inning of an AI infrastructure build-out of historic proportions.
This unprecedented level of spending, this technological arms race, it really all boils down to a single, defining question for the next decade.
So you have two giants deploying hundreds of billions of dollars of capital. One is playing a broad, ecosystem-wide game. The other is laser-focused on the enterprise. The defining question is this: whose strategy is right? Which approach will deliver the better return on all that invested capital and ultimately win the race to define the next decade of technology? The answer will shape our future, and the battle has really only just begun.